senior management, Shyam Srinivasan, MD and CEO of Federal Bank now, joining in to talk to us about how the quarter has been and, of course, what lies ahead of the company. Well, thank you very much, sir. It's a pleasure to talk to you today on the show. Federal Bank has beaten street expectations once again. Strong quarter for the bank. Margins have expanded significantly as well. Start by telling me what you thought about the quarter behind you, whether or not these margins are sustainable going ahead, and generally the outlook for FY25.
Thank you. Yes, we did have a good quarter. You may have seen early July when we declared our provisional balance sheet growth numbers. We had pointed out that our credit and deposit grew sequentially almost 5%. That's almost annualized 20% growth. And I'm happy that as we speak today, having seen 10 odd banks come out with their numbers, we have delivered well and suggesting we are gaining market share, which is important for us. So growth has been steady, and we haven't compromised either quality of deposits or quality of credit in the bargain. So consequently, the quarter that went by saw the highest ever both net profit and interest income growth. And importantly, interest income growth matched our credit growth. So the quarter that went by was good. I think we've begun the financial year well. One hopes that we continue and keep this momentum for the FY and deliver on our promises for the numbers and expectations that we have for ourselves. It's a good quarter, good beginning.
Okay. Thank you, Mr. Srinivasan. Harsh also joining in. I want to try and bring your view with regard to credit costs and slippages. Now, generally, Q1 is a seasonally tough quarter for you. But this time around, you've done very well when it comes to both credit costs as well as controlling the way in which the numbers have come out. Talk us through the sustainability of that. Are we at the bottom of the cycle, or do you expect this as a key lever going forward to maybe unwind?
Yeah, Harsh, I think you've been speaking to us for some time. Credit quality of our bank is something that we've been adamant about. We haven't strayed away from our original aspiration and risk appetite framework. And I think that's playing out quite well through most cycles. We haven't seen disproportionate runaway problems in credit. We've traded off some growth for quality of credit, and I do believe that philosophy hasn't changed. So even our outlook for the financial year for credit, we've guided, last quarter was 27 basis points credit cost. We've said it could be in the 30, 35 basis points for the full year, which means it's going to be in that range. We should not see anything dramatic or adverse coming up. And as long as our collection intensity is in place and in fact stepped up further, this kind of run rate on slippages and recoveries upgrade should be in place.
Right. So before I come to growth and compliment you on that count, I want to try and cover margins more specifically. They've been range bound. It's of course a tough environment where margins is concerned. You've managed to hold on. What should one expect from here for FY25 and beyond, if at all a rate cut were to come through?
Beyond is hard to tell right now. I think we'll have to keep it. We think this financial year, we've said in the quarter that went by was sort of flattish. We believe that's where it will be for the financial year. I would encourage that we don't look at margins standalone, because we have to look at interest income growth. We have to look at credit quality, cost of credit to arrive at the final outcome. But margins by itself, we believe will be in this horizon, in this range, 315 if you're lucky, 320.
Got it. Very strong growth, both on advances and deposits. Give us first on the deposit side, because that's very impressive. What's really working?
I think the big driver of deposit growth has been that, I'm sure you've seen it, it's largely retail. We are trying to debulk as much as possible to keep our deposit growth sustained at retail and granular. And for the fact that we added over 100 odd branches, in fact, 140, 200 plus branches in the last 18 months, they are bearing, we're reaping the benefits of that. The focus around different product launches that the team has done. And even more importantly, one key driver, which was seeing degrowth, has started coming back more positively, which is the NR deposits. So on the back of expanded footprint, new product capabilities, and a reversal in trend in the how remittances convert to deposits on the NR side is turning out to be hopefully where we would like it to be. So that combination is ensuring that our momentum is there. And of course, the teams have done a great job of getting a current account momentum back.
Yes, absolutely. Very, very strong deposit growth, been very impressive. On the advances side, talk to us about how you're growing advances, because we're seeing some pockets where, especially in retail, unsecured, where we've started to see a bit of a spike where asset quality is concerned. I mean, it's getting adverse. Talk us through what your experience is on unsecured, as well as talk to us about how you're calibrating growth in some pockets, if at all you are.
No, I think our credit growth has been between the 16 and 20, 16 at the bottom end and 20 at the higher end for many quarters. And it's been very broad-based, you may notice. It's never one business. It's across corporate, commercial, retail, and within retail, gold, home loan, LAP, with the introduction of new products like credit cards, personal loans, and commercial vehicles. These are all sort of gathering momentum. Businesses like credit cards, personal loans, commercial vehicles are small-based businesses, so the growth is a little more exaggerated. But if you blend it, our growth has been about 4 to 4.5% each of those verticals, and sequentially. And I think that momentum is very possible. We believe FY25 should reflect these initiatives and see the growth in that range. And I don't think that will change unless we choose to cool off because growth in the market is sort of tapering off and or deposit costs are just ballooning. Given all where we are, we believe our growth momentum should sustain in this ballpark. I mean, don't hold us to exactly, you said 20, it could be in the 18 to 20 bracket.
Got it. And do you see corporate coming back significantly to probably aid that growth number for you? Because we've seen broadly corporate capex hasn't come back. So just getting a sense from you.
We believe there's scope for growth. We've seen pickup and that should sustain.
Okay. Now I want to come to OPEX because OPEX to assets or cost to income, as you would call it, has of course come off on a sequential basis of a higher base. But it's not coming below the 50% mark. Do you expect it to sustain at the around the 50% mark, or when can we start to expect Federal Bank to start delivering on that lever to aid ROAs?
We believe Federal Bank will get to the 50%. We were on course, but then we have repivoted to ensure some more costs around technology, some more around branch expansion, and building our brand are important for us. So we don't want to get fixated on getting to the 50 in a rush and compromise. But directionally, we're there. Every quarter should see some improvement. We believe in FY25, we may get closer to 50, 51, 52 by end of financial year, and then the following year get closer to 50.
All right. And sir, with regard to ROAs, the key concern where analysts on the street are concerned, they seem to be worried about the ROA levers that Federal Bank has. There seems to be a belief that there aren't enough ROA levers to push ROAs above the 1.3% mark. Would you beg to differ?
Yeah, I mean, we've defeated many of their theories, which is why we are a bank that has delivered more than what they expected, right? So I'm of the view that what we have promised to get to 1.4 by FY26, we have plans and levers for that. This is arithmetic. Then there's below arithmetic, there's action. And action is where the outcomes are born, right? So we shouldn't get too fixated on the formula. Many formulas are only formula. So I'm of the view, if we get our cost income improvement, there's some gain. Credit costs are reasonably okay, but there are times when we can do even better. The business mix pivoting is happening quite well. Coming back of NR deposits is a strong lever. So I think we have a few irons in the fire, so to say. The teams are quite excited about that opportunity.
All right, sir, last off, succession. What's the plan? What's the way forward? How do you bring in Mr. Manian, and what changes in terms of strategy in your view?
The last one is for Manian to answer, not for me to answer.
Sure.
Right? We will do everything to smooth transition out. He and I have a lot of conversations going. We will have a nice plan to make sure that It's reasonably seamless. And then from then on, he will build and deliver even better. I have, utmost faith that both he and the team will make sure that the story is only beginning.
How long has this been in the works for? Because we were one of the first to break the news. But talk to us about how long this has been in the works for.
I complimented one of your colleagues yesterday when in the press conference she was asking me. I said she knew everything before we knew, right? We had not even started the conversation with the gentleman.
So now, sir, I think you need to call us before you make any announcements, just to check back.
Yeah. You have a horoscope of everybody sitting in front of you.
Prediction, we're great at it. But congratulations, thank you very much. Good luck, and we'll hopefully see you soon again.
Thank you very much. All the best.